Good morning, all IPS students and guests. In our weekly Zoom meetings, we have one meeting on direct taxes about the income tax. And we have a eminent speaker and senior most chartered accountant, CA YV Bhanunarayan Garu, and he's also the past chairman of Chartered Accountants Hyderabad branch, and he is an expert in income tax, and he has handled the various issues on appellate stage also. Now we have who was his treasurer under his chairmanship, and CA Satish Kumar Garu. So he's there, and he is going to introduce the speaker. Sir, now for you to introduce the speaker.
Good morning to everyone. First of all, I should say big thanks to DB Prakash sir from the Institute of Practical Accountancy for giving me this opportunity to introduce our esteemed speaker of the day, CA Bhanunarayan Garu. Welcome, Bhanu sir. Before introducing CA Bhanunarayan Garu, I am very happy and feel privileged to share that Bhanu sir is like my elder brother, under whose leadership I served as a treasurer for Hyderabad branch of CA Institute, and we'll got a lot of good things from him like discipline, dedication, diplomacy, and giving directions to juniors like me. Thank you, Bhanu sir. CA Bhanunarayan YV become a CA DSA, qualified as a chartered accountant in the July 1989, and he has been in the practice since then as a founder part of Messrs. VS MB and Associates, Chartered Accountant, Secunderabad. Taxation and auditing are the main core areas of his practice. He practices in the fields of direct taxes on the original side as well as the appellate side up to the income tax tribunal. He has over 30 years of experience and has given lectures on different topics of direct taxation at various forums like for last 15 years. He was elected to the managing committee of Hyderabad branch of ICAI twice, first in the year 2016 to 19, in which term he served as treasurer, secretary, and vice chairman, and again for the period 2019-22, in which year 2019-20 he served as the chairman of prestigious Hyderabad branch of ICAI. He also serves the society through the Lions Club International and held several posts in his club as well as the organization, including that of the Cabinet Secretary of Lions District 320C in the year 2014-15. He is a leadership trainer in Lions Club as well as trains Lions Club members and students on personality development and public speaking. With this small brief profile, I am presenting CA Bhanu Garu. Bhanu Garu, now it's your turn.
Thank you. Thanks. Yes, sir. Sir, now it's for you too.
Yeah, thank you, Prakash, and thank you, Satish. Before I start my session, I would like to thank Satish for the kind words that he has used while introducing me. Satish, it is also because we are still the committee members till March end. So it is very nice to be in the same committee as good members like you and Master Rao and others. And friends, Satish Mailavarapu is also a senior chartered accountant and a very dedicated service-oriented member. So it has been a very pleasant surprise for me when in the morning when I logged in, I was told that Satish is going to introduce me. So thank you, Satish, and thank you, Prakash, for making this,
it's our pleasure,
giving me this pleasant surprise.
Nice.
And coming to Prakash and IPA, Prakash and myself, we know from 1999 when I joined Lionism, and we have been co-presidents, co-zone chairpersons. And then, of course, Prakash became region chairperson, and I took the other route into the administration. And with IPA also, I can proudly say that I have been associated with it since a very long time, though not on a very regular basis. Very now and then, I've been participating in their programs, and also in the early 2000s, I used to give lectures immediately after the budgets were presented. Then after, due to my preoccupation with other activities. I was not able to participate much, though I was always participating in this IPA awards ceremony, which is very unique. And he selects people from the various fields in the accounting profession and the finance profession and gives them life achievement awards, lifetime achievement awards, and special awards, which is very motivating to the people in this line of activity. So I really appreciate you, Prakash, and
Thank you, Bhanugal.
I would pray to God to give you the necessary strength to continue this good activity, not only for the students, but also for the profession, the professionals and the teachers that you keep honoring. Now, this is a 1 hour program or a 45 minutes?
Yes. No, this is a 1 hour program.
1 hour program. Okay,
Up
thank
to
you.
11 o'clock.
Okay, thank you, Prakash. And friends, before we go into the main topic, I would like to start with a small quotation from Chanakya or Kautilya, his original name. So Kautilya is very popular over the centuries in India. He is known for his shrewdness and his practical approach, and he is a master strategist. So people still remember his sayings, even though he lived several centuries ago. And one such saying in his Arthashastra is, the king should collect taxes from the subjects like a bee which collects honey from the flowers. But friends, how many of you agree that the governments follow that? It is not an interactive session, so I may not be able to know the immediate response, but I know everybody in your heart and mind, there is no conflict when it comes to this topic. All of you will say Kautilya's advice is not followed because taxes are collected in a way which is convenient to the government, and they do not bother if it pinches the subjects, like taxing the pensioners, taxing certain things. So many things are there that which you can discuss in a different forum. Now, why I started with Kautilya is collection of taxes. And today's our topic is Finance Bill, direct tax proposals in Finance Bill 2022. Now, a tax can be collected by the government only by the backing of the Act, backing of the Finance Act. So the Act to be passed in the Parliament, the government has to introduce a bill that is called the Finance Bill. Once a Finance Bill is introduced, it is supposed to be debated in the Parliament, then passed by the Lok Sabha and sent to the Rajya Sabha, and after it is passed by both the houses, it is sent to the President of India for getting his assent. And once the bill gets the President's assent, it becomes the Finance Act, on the basis of which the Government of India collects taxes. This budget not only has direct taxes proposals, it also has various, like in the earlier lecture, the learned speaker, I am told that he has spoken to you about the various aspects of the budget, like the different terminologies and the facts and figures. So if you can recollect, then there's what is budget? Nothing but every house has a budget, like your father or mother, whoever is earning, they will calculate what will be the income the family gets and what will be the expenditure that has to be allocated to the various basic needs and necessities and other aspects of the family. Without budget, everything goes for a toss. Now, suppose 50,000 is the monthly income of a family. So the family head, along with you people, they will have to plan how to spend this 50,000 judiciously so that it takes care of the needs of the family as well as the education, the medical needs, the future needs, like where to save, where to invest for marriage purposes or education purposes or sending you abroad. If the family income is 50,000 or 10,000 or 10 lakhs per month, this budgeting is essential. Similarly, if we scale up, budgeting is necessary for every organization, not only your IPA will also have a budget. I'm very sure that Prakash will be very frequently analyzing the receipts, payments, and uh, he will be drafting and doing his budgeting, and also comparison of the budgeted figures with the actuals, say after 6 months, whether we are on track or whether we have gone wrong somewhere or some emergency expenditure has come and how to meet that emergency expenditure. So all these things will be there for every organization. Similarly, every government also has to plan as to from where it will generate sources and how it will spend the sources for the benefit of the country and the welfare of the people. So like that, you have so many areas to spend, like defense, education, Medicare, payment of interest, repayment of loans, and service sector, social sector, giving freebies, taking care of the fertilizers, taking care of the farmers' needs, and so on and so forth. The list is very big. Housing for the poor, affordable housing, then incentives for going green. This year, the budget has focused a lot on going green concept and technology. And even the RBI is introducing digital currency shortly. Then how to raise the funds for that, all these things are there. In that, direct taxes is one of the important source for generating revenue for the government. It almost comprises about 15%. We need not go into much detailed figure. We have some thumb rule, about 12 to 15% of the revenue is taken from the direct taxes by the government. Similarly, about indirect taxes, the GST and all also will have about 15 to 16%. Various other sources will be there. Now, the proposal. What is the proposals of the government of India for this fiscal year 2022-23 through the Finance Bill 2022? So, since we are at the level of students level, so Prakash, I will not be going into the very detailed and minute aspects, but I will cover the broad overview so that
Yes,
it will be
please.
easily understandable to
You
the
you
student.
can show that the slide presentation also, please, kind. Yeah, you can do.
I will do that. And the second thing is, while discussing the direct tax proposals, what the finance minister speaks in the budget are only the salient points. This year, there were not many salient points. She just covered it in a very short time. But to bring those salient points as clauses of the finance bill, there is a document called Memorandum to the Finance Bill, which is like our Bible or the Bhagavad Gita or the Holy Quran. Like so many verses are there in the holy books. Similarly, in this finance bill for our finance professionals, it is also like a holy book for us. It has got some divinity for us. So that memorandum of finance bill is the most important document for explaining as to why a clause is being proposed in the finance bill. That is, if a budget proposal is there, that will be dealt with in detail in the memorandum. So my suggestion to students is that once the budget is prepared, is announced, the government of India releases in the software, a software copy, that is a PDF of the budget and the finance bill and the memorandum to the finance bill. So please download that and read it whenever it is convenient to you, but don't take it so long. Maybe in 3-4 days time or 1 week's time, you allocate a few hours every day, maybe 2 hours or 3 hours, and read the memorandum of the memorandum to the finance bill, so that you will understand as to why that particular clause is being brought into the finance bill. They will give an explanation as to why, what is the need and why it is being brought into it, and from when it will be effective, and what was the reason. Suppose there are some court judgments which have gone in against the government, they will try to also correct it through this finance bill, through the amendments in the finance bill. So my suggestion to my students is that if you want to get good knowledge of the budget, apart from listening to the speeches, you should also make an effort to understand why the government is coming up with the proposals. For that, memorandum to the finance bill is very important. So it is my request, and I hope that all of you will participate, will agree to it, and you will put it into practice. Now, coming to the next slide, this is the budget at a glance. So the revenue, receipts and expenditure, the capital receipts and expenditure for the Union Budget 2022-23 are clearly explained here. So the government is really doing a very balancing act by doing all these exercise. This is very important. This slide is available with IPA, that is our Prakash is having this slide. I request him to share with all the participants.
Yes, sir.
This can be also to just deal with this. I think last week you had your session, and it is very interesting. Once you go through this, it will give you not only knowledge, but also it will increase your enthusiasm in knowing about a lot of things about how the union government is going to raise revenues and spend the income. And this is a very useful chart. You can go through it, and this is in the diagrammic form as to how the income is being generated and how the expenditure is being spent. So as I told you, income tax is about 15% of where the money comes from. Then customs, excise is customs is 5, excise is 7, GST is 16, then corporation tax is 15. So like that, the several government schemes they are going. So today we will discuss only some of the important provisions which are useful to you in your daily practice, or which is of useful use in the daily day-to-day working of the commerce professionals. So one very important amendment that is being proposed is the introduction of what is called as updated return. Is it clear on the screen, Prakash? Is the slide
Yes. It's okay. Yeah.
So it is called a new section has been introduced, 139(8)(a), wherein you are allowed to file a revised return. But it is not called a revised return, it is called an updated return. Earlier, one was having the liberty to file a revised return. If the original return is filed on time, they could revise up to the end of 2 years after the assessment year. Subsequently, the government started reducing the time frame, and presently, that is for the assessment year 2021-22, it is 31st March because of the extension. Otherwise, it would have been 31st December. That means in every assessment year, if July or September is the due date for filing the return, then the due date for filing the revised return is only December. So that means the government has tightened the rules. That is, you have to file your return properly by taking every care that you have included all the requisite information and shown all the incomes that have accrued to you or as arisen to you or received by you in during the previous year. So I'm very sure that the concept of assessment year and financial year or previous year, financial year is known as the previous year. So all these concepts are very well known to you. So we will not go into that in detail. But now the government has come with a concept called an updated return. That is, any person, whether or not has furnished the original return of income, he can file an updated return from within 24 months from the end of the relevant assessment year. That is, from the next year onwards, you can file an updated return within 24 months from the end of the relevant assessment year. We were all very happy when this statement was made, but it comes with some riders. What are those riders? Like, you can only file an updated return if you are giving more revenue to the government. If you have made a mistake by showing excess income, you cannot file an updated return for claiming a refund or claiming a loss. So the riders are for filing an updated return are: updated return cannot be filed if it is a loss return. It cannot be filed if it has the effect of decreasing the total tax liability or increase in refund claimed, or in cases of search or survey, if a search or survey is initiated, then you cannot file updated return, or any proceeding for assessment or reassessment is already pending, then you cannot file. Then if any notice is issued under the Prevention of Money Laundering Act or such other acts, then also you cannot file an updated return. Or if you get any information with respect to section 90 or 98, that is with respect to some foreign income, even then, and if that such communication is communicated to the assessee, then such assessees cannot file updated return. So the rule is, in sum and substance, if you have forgotten any income, only then, and if you have not received any such of these notices, then you can file updated return. So far so good, but still there's something else. You just cannot file your updated return. Like, up to December you can file a revised return with no extra cost. Whatever is the tax, you can pay and file. But is updated return, it comes at an extra cost. What is that extra cost? That is, if you file within 12 months from the end of the assessment year, then you have to pay an additional tax of 25%. And if you file, that is between 13 months and 24 months, because 24 months is the time frame given. So if you file within 12 months, you pay 25% additional tax. If you file within in the time frame of 13 months to 24 months, then 50% of the aggregate tax is the additional tax. What is aggregate tax? It includes tax, surcharge, and cess. And also, if you are filing updated return for the first time, that late fee under 234F also will be included. I hope I am clear so far. Next important thing is TDS provisions. One TDS provision is 194IA, that is relating to TDS on sale of property. That is, if a buyer under the Indian tax laws, present tax laws, if a person is buying property worth 50 lakhs or more, then he has to deduct TDS at 1%. This was basically the document value. That is the agreed consideration. But there is another section in the Income Tax Act which says that if the stamp duty collected, the value adopted for collecting of stamp duty by the sub-registrar is higher than the agreed consideration, then that will apply. What will apply? That stamp duty consideration. So similarly, they have amended this TDS section also, wherein it says that you have to collect, you have to do TDS on the stamp duty valuation or actual consideration, whichever is higher. I think it is clear, it is straightforward, so there is no need for further discussion on this. What does it say? Even TDS you have to do at whatever rate is prescribed. It is 1% if it is transaction is between two residents in India, then it has to be done on either stamp duty value or the actual consideration, whichever is higher. Now, the section 194R, we will come back later. I will talk to you when we discuss something. Now, we'll come to a new concept that has been brought into this finance bill, that is called a virtual digital asset. What is a virtual digital asset? Virtual digital asset has been defined under section 247 of the Act, which is the definition section of the Income Tax Act. What is a virtual definition? Virtual digital asset, it has been defined under section 247 subsection of the Income Tax Act, which says that in what are the various assets which are considered as virtual digital assets. So basically, in common man language, it covers what is popularly called as cryptocurrency. Most of you must have heard about cryptocurrency, and some of our friends in foreign or even in India telling that they have they dealt in cryptocurrency and they made some profit, or some people telling they made huge loss. So what is all this? That has now and then the Supreme Court said that it is not legal in India. Then they said, no, it is not like that. It is up to you. Then the government was also not clear on, there was no specific section to discuss about taxation of such assets. So people were doing as per their own will and their own and advice of the auditors or chartered accountants. Some were treating it as a long-term gain or a short-term gain or loss under capital gains, and some were treating it as normal business transactions and admitting the income or reducing the loss from others or other income. All such things were going on. So the government has ultimately recognized that it is a necessary evil that has to be dealt with. You cannot ignore it any longer. So they have given a definition, and they have said that if any gain is there, it will be straight away taxed at a flat rate of 30%. The only expense allowed is the cost of acquisition, and it has provided a specific section for that. And set off of loss is not allowed. And another 194S section has been introduced, wherein there will be a withholding tax at 1% by that exchange through which you are dealing with these in this virtual digital assets. And even if it is in consideration is in kind, even then the TDS will be applicable on the deemed value of the assets. And if it is a HUF for individual not covered by tax audit, if the transaction is below 50,000, TDS will not apply. And if it is above 50,000 above, it will attract TDS. And for other assessees, that is firms, companies, and others, the 50,000 has to be read as 10,000. That means the government, though not happy with these cryptocurrencies, has considered the fact that it has become prevalent worldwide, and it is bringing it under the tax net. But one thing, friends, the taxation and legality are not going to be on the same footing. Income Tax Act can tax even illegal transactions. This much you remember. Even if it is income from smuggling or income from cryptocurrency, which is banned, whatever it is, if somebody makes a gain, they have to pay tax on that. Just by saying that I am taxing that income, the government does not say that by taxing that income becomes holy income. It is still illegal if it is considered illegal. So please do not deal with such things. It is an advice from me and several other CAs. It is your personal risk, but it is not advisable to go into such transactions and deals. Next, there is one section 40. In the section 40 of the Income Tax Act, there is section 40, subsection small a, clause 2, which says that while computing the taxable income, deduction shall not be given for any tax or paid. Okay, tax or surcharge or cess, whatever it is called, it shall not be allowed as a deduction. Suppose in the profit and loss of a company, we say income tax is debited to P&L account, because normally it only happens in the case of the corporate assessees. Then you have to add back that to the profit and loss account, and you have to consider only the pre-tax profit for calculating income tax. So this is clear, but some intelligent people, what they have said, that this education cess is not a tax or surcharge. It is a separate cess which is levied by the government for the specific reason of raising funds for spending it on education and higher education. So we all know that we pay tax, surcharge if the taxable income exceeds certain limits, and then we also pay cess. That says education cess of 3% plus 1% higher education cess, that is 4% that we pay, that is collected by by the central government, who spend specifically on education. Like that, the government has a right to levy such cess as and when it is required. Like during the Gulf War, a cess was levied. Like that, similarly, some amount will be collected in the form of cess. Then the courts also were agreeing with the arguments of the assessees and their advocates that cess does not form part of this tax or surcharge. So the government wants to clarify. It says that with retroactive effect from 1/4/2005, it is always deemed to have been deemed that cess shall also be included for the purpose of 40A clause 2. Fine, sir. So if you are paying income tax plus surcharge plus cess, then better add back all the three, because this will have impact on very high companies with very high levels of income, where even that 4% will run into several crores of rupees. So that is why they were trying to take advantage. Now that cannot be done. The government has sealed that, saying that this definition always included cess, so no playing around with it. Now, there is some very good incentives given by the government for companies that are manufacturing companies and which are newly established. So for a newly established domestic manufacturing company registered on or after 1st October 2019, then if it commences the production before 31st March 2023, then the taxation is a soft rate of 15%. Otherwise, it is for normal companies, the rate is 25%. For a special concession is there on 115B AA, that is 22% plus surcharge, and for this it is 115 BAB, it is 50%. but it comes with a rider that they will not allow any additional depreciation or carry forward of loss on certain types of losses, which is clearly defined in that. Some other day we will discuss that, not today. So what government said, due to COVID and all, there has been a disturbance. So they are extending the date of commencement of manufacturing or production to 31st March 2004. By 1 year they have extended. This is also a very welcome move, and it will help the domestic manufacturing companies who want to opt for this section 115 BAB. Now, there are certain startups. We have been hearing a lot about startups in these days. So what is a startup and all is defined under the Act, how it is taxed and other things. So under the present provisions, under Section 80 IAC, a startup is entitled to a deduction of 100% of the profits for any 3 consecutive years out of the first 10 years. The only thing is that 10 years, it should be beginning from the year of incorporation, that is on or after 1st April 2016, and it should have been incorporated before 1st day of April 22. That is, if a startup is incorporated between 1st April 2016 and 31st March 2022, then it is entitled to a deduction of 100% of its profits in any 3 consecutive years out of 10 years beginning from the year of incorporation. I think this is clear. I think there is no ambiguity in this. It is very clear. Now, seeing this COVID condition, the government has extended by 1 more year. That is, it has to be incorporated on or before first day of April 2016, and it should be incorporated before 31st March 2023. So this is also a very welcome provision. So which is of benefit to the startups. There are several startups in India, as you all know. They are called unicorn companies, and they're doing excellent businesses, especially in online business, like several things in hospitality or food. So many things they are doing. The only thing is, it should be recognized as a startup by the government. There's a specific department where you have to apply for recognition as a startup. And if you do it, a lot of people are coming forward to finance also. So many venture capitals are coming forward to fund. And well, it is a total different experience. We can always have a session on startups. And I hope DB Prakash will bring one of the experts on startups, and maybe after listening to him, some of you can also start a startup and come out with flying colors and get good fame across the country, and be of benefit to the society. Now we will come back to another normal provision, that is Section 37. And Section 37 gives a deduction. It enables an assessee to avail a deduction if any expenditure is incurred in connection with his business, but it is not specifically mentioned in any other section. Say like bad debts, Section 36(2) is there, or example, depreciation, Section 32 is there. So several sections are given for claiming deductions from business income, and this is the general section. So in general section, what used to happen is, I incur some business expenditure on some person, and that used to be claimed by me as a business expenditure, because I used to make a claim that it has been incurred in connection with business, and if I do not do that activity, or if I do not spend on that activity, my business will not be able to stand in competition with my competitors. So this was specially brought in for pharma companies. India, you know, especially Hyderabad is a hub for pharma companies. So what pharma companies do, they catch hold of the doctors and hospitals to encourage them to prescribe the medicines manufactured by them. And if they prescribe the medicines manufactured by them, the doctors will be given some incentives in cash or in kind or whatever it is. They will be sent on foreign trips. They will be sent to Kashmir. They will be sent to Andaman, if not foreign, at least some local trips, or they will be given some lot of gifts, incentives, so on and so forth. Then the government of India has come up with the medical council. They have come up with a rule that it is an unethical practice. This amounts to trying to force the doctors to prescribe your medicines by giving them some gain in return, a quid pro quo type of arrangement, which is unethical in nature. So government said that the pharma company should not do this. Now the question came, if it is prohibited under any law, whether you can claim as a business expenditure in computing your taxable income. The government said no, and now it is specifically brought into the act, which says that if any expenditure is incurred to provide any benefit or perquisite to a person, shall not be deductible while computing the taxable income if acceptance of such benefit is violating any law governing the conduct of such person in India or outside India. The same example they have given. Medical practitioners are prohibited from taking any gifts from pharmaceutical companies. So if it is ethical and legal, then you can claim. If it is not ethical and if it is not legal, it is prohibited by the government, then you cannot claim. So this is basically going to curb all such unethical practices wherein people are lured to prescribe their medicines, especially the example given is pharma companies. It could extend to some others also, but normally this practice is resorted to mainly by pharma companies. So I said earlier in one of the slides there was 194R that deals with TDS on such things. Earlier there was no TDS. Now you have to do TDS. If so, the government will come to know the moment you do TDS under that section, the government will know that certain transaction has taken place which is not permitted by law, and it will take note of that PAN number and other thing, and it will use against the SSE when it comes for this assessment. So better we follow the law properly and see that you do not land into trouble later on. Now, same thing is much more in detail, and also if you pay any compounding fees, that was example of a gift given by pharma companies to others. Then there are certain other things, like if you pay, suppose ROC, late filing fees, some companies used to, due to some reasons, not file for 2-3 years or several years. Suddenly they will file everything in 1 year by paying compounding fees, by late fees. All such things now will be covered by this, and it will not be allowed as a business expenditure, which means that your taxable income will increase. So government is doing all this, saying that you should be more careful in conducting your business and you should not take any benefit for regularizing at a later date. Anyway, whether it is good or bad is a debatable issue. We can discuss only what the intention of the government. So we have to be careful. So you have to advise your clients wherever you are working, or if you are a consultant, you have to take note of all this and do it. Then there is an AMT. What is AMT? Minimum alternate minimum tax. So what is this? Nothing but, suppose book profit is there, but because of some huge depreciation allowance in the income tax or some other expenditure in the income tax, your profit is reduced to a loss. Earlier, a lot of companies used to do this. Listed companies, they used to declare huge profits and declare dividend. then their share prices used to be massive movement and they were benefited. But when it came to payment of taxes, they would say our company is a poor company, loss making company, that allowance, this allowance, so I'm entitled to that depreciation, this is depreciation, hence my taxable income has converted into a loss, so I do not pay any tax. So government said, okay, certain amount you have to pay if you declare a book profit. Then they gave a formula wherein it said that is, if you have a book profit and the tax on at so and so rate of book profit is X, and suppose your normal tax rate is Y, so whichever is higher you have to pay. You cannot escape. One way you saying that I have huge profit and declare dividend to your shareholders, make them happy and see that your share price goes up and your market capitalization goes up, and one side you are keep taking that stance, and when it is coming to paying of tax, you are saying that I'm entitled to that allowance, disallowance, and you are not paying anything as income tax. So this concept of minimum alternate tax, it first started with companies, what we popularly call as MAT. I think all of you have heard of MAT in your syllabus also. That is minimum alternate tax. It started for companies. Later on, it got extended to cooperative societies and also firms. And the name was not MAT, but alternate minimum tax. Now, there has been, over the years, there has been a situation where the company pays only 15% MAT tax, whereas cooperative societies pay AMT at 18.5%. Now, cooperative societies may not be that popular in Telangana or Andhra, but they are very popular in Maharashtra, Gujarat, and Rajasthan. That is milk cooperative societies, so many cooperative, sugarcane cooperative societies, so many societies are there which are very powerful, and most of the leaders who are ministers, prime ministers, chief ministers, they have become leaders only through by being leaders of the cooperative society movements. So they are having so much hold in those parts of the country, the western part of the country. So they are paying 18.5. Then the government, there was representation to the government saying that how can this be like that? Companies are also corporates. They are being taxed at 15, whereas cooperative societies where more common man, farmers and all are involved, it is being charged at 18.5%. So government said, fine, we will bring parity. Now even for cooperative societies, the AMT will be 15%, which is on par with MAT for companies, which is also at 15%. So this is also a welcome move. We need not have much further discussion on this. So if it is a good move. Now, then there is one very, very draconian act by the government. We cannot say draconian, but a dangerous act. Now, you know that there is a provision for setting off of losses. So that is, if you earn income, you can set off the brought forward losses against your income and only pay tax on the balance. Suppose 1 crore is your income, you are having say 50 lakhs brought forward losses, then that 50 lakhs will be set off against this 1 crore and you will be paying tax only on 50 lakhs. This provision was there even for companies which have been raided. That is such case or survey case, whatever it is, they used to, a team comes from the income tax department and says that you have not disclosed so much of income. So until you will be reading in the newspaper, so and so person was raided and so much was the declaration, fancy declarations the government officials will take from you, 500 crores, 200 crores, 50 crores, like that. And ultimately, they have to collect tax on that. But when it comes to collection of taxes, what these assessees do, out of the amount declared, they will say, I have that loss, this loss, and they will adjust the losses. So now the government felt, see, after conducting a search or survey, we spent so much of time in preparing and in analyzing how much. See, they will not do a search or survey simply like that. They will spend time on you, that is, they will do recce. They will do lot of analysis on how you are spending, what is your lifestyle, where you are going, how you are traveling, how many cars you own, which clubs you have membership, how many foreign trips you have gone, all these things, what is your household income, what are your activities, they will know. Like just like the CID police, the finance department also has a policing force. We can't say policing, it's a task force sort of a thing. In Mufti, they will follow you. If suppose you have come, you have performed a wedding, how much, what was the venue, what was the food served, they will come gate crash and eat also. What was the food, how much jewelry your family has worn, how many VVIPs have come, all that record will be there. So they go, they do so much work, they get a declaration out of you by using several methods, and ultimately the tax paid is hardly anything. So government will lose its face, and the assessees will also win the cases because it is permissible under law. If there is a loss, you can set off against income. So the government has now come up with a strategy stating that if any income is declared under a survey, during a survey or a search, then no loss will be allowed to be set off against that. If you disclose 100 crores, you admit 100 crores as undisclosed income, pay tax on 100 crores. These laws, other things you see later against your regular incomes, nothing out of undisclosed income. So this is the definition that I have given. The sum and substance I have told in a very simple language so that it is very easy for you to understand. Then this is also same thing. Now disallowance under section 14A. Under section 14A, there is a section in the Income Tax Act which says that if you earn any non-taxable income, that is, if you earn any income which is exempt from tax, then certain amount will be disallowed as a deemed expenditure, which is actually not a very, to frankly speak, it is a very bad section. See, if I incur any expenditure to earn exempt income, you disallow something, there is logic. Suppose I do not incur any expenditure, but still I get income, like I have invested in some tax-free bonds without borrowing anything with my own funds. Then where is the expenditure, and why you should allow, why you should add back something towards expenditure under deemed expenditure? Very draconian. Earlier, it was very used very frequently because dividend income was exempt in hands of the receipt. So this used to create a lot of problem. But now, since dividend income is not there, I don't see much in relevance for this, except for few incomes like share of profit or from a firm or from an AOP or some agriculture income or tax-free interest, certain things. So the importance is not much, but nevertheless, since it is there, now it is said that if you get, if you earn non-taxable income, then a part of it will be disallowed. How to calculate and all, there is a separate formula that whenever we discuss anything specific, we can learn. And another advice to the students, this is a very small presentation that I have given because in 1 hour a budget cannot be explained. But these sections, whatever I have given, you please go through, including the memorandum, go through your study material, go through the ready reckoner, go through the act, whatever it is. If you do your homework, then you will feel confident and you will gain some knowledge and you will develop interest in this line of in this budget and direct taxes. It will enhance your knowledge, and knowledge once gained will never go waste. Somewhere or the other, it will be useful to you. And 43B, section 43B deals with the certain expenditure will be allowed only on payment basis. Even if you follow mercantile system of accounting, that is accrual basis, certain expenditure like statutory payments like GST or PF or there's a big list what are the statutory payments, and also interest paid to nationalized banks on the loans taken, all that will be allowed only on payment basis, even if you follow mercantile system of accounting. Then, as you know, our we have very intelligent people. They started converting the interest payable into debentures and said that I have discharged my duty. The interest is deemed to have been paid because I've converted into debenture. Now, specifically for that, this clause has been brought in this finance bill, which says that such conversions and all are not allowed. You have to actually pay. Only if you actually pay, the allowance will be given. Otherwise, it will not be given. And this is very dangerous section. That is section 68. It used to be there long back, but the courts were very liberal. So now they have brought it back. Now, suppose, for example, I am in need of, say, 1 crore rupees. My business bank is not giving or it is delaying. I want 1 crore. I go to DB Prakash and Satish and request them, boss, I want some money. Can you lend me? I'll pay interest. So what they will do out of their friendship and goodwill, they will say, okay, I will give 50 lakhs each. We will give 50 lakhs each. You meet your business needs and later you repay. So we'll enter into some agreement wherein I'll pay them an interest of so much and I'll repay the principal. Now, for their act of kindness, I have to be rude to them. First, I will say, I want money. They will accept. I will say, thank you for accepting to give. But now tell me, do you have the source? What is the source? How are you going to give it to me? You please explain. So I am going to annoy him, but I am forced to do because of this section. This section says I have to prove the source for the source. That is, if DB Prakash is giving me 50 lakhs, I have to ask him from where he got that 50 lakhs. And he has to give me the proof. 50 lakhs I have earned like this, I have earned like this, or my daughter or my son have given me gifts like this. So out of that I am giving, this is my PAN number, I am assessed to so income tax. Earlier, we used to simply take a letter confirming that he has given and we used to submit. And if at all the officer has to proceed, he has to proceed through his assessing officer, saying that so-and-so DB Prakash has given a loan of 50 lakhs to one Banu Narayan. We have come to know, so you please examine his case. Now the officer can summon DB Prakash and say, you prove your source. If you do not prove, then I will have to pay the tax even on the loan that I have taken from DB Prakash, because he has not proved his source properly, and also he will also be in trouble. So this is going to be very draconian. However, the only saving grace is if we are getting money from well-regulated entities, then we need not show the source for source. Okay, so it is proposed to amend the provisions of 68 so as to provide that the nature of source of any sum, whether in form of loan on borrowing or any other liability credited in the books of an SSC, shall be treated as explained only if the source of funds is also explained in the hands of the creditor and entry provider. So please be careful. This is draconian. There are several post-budget memorandums have gone asking to asking them not to go ahead with this, or at least give some threshold limits like loans only above 1 crore or 50 lakhs, like that. Let us see what the government will do. And penalties, okay, this penalty, even the appellate officers, if they enhance the income, they can do this. And this is one very welcome move, that if any case is there in your favor or a similar case is there for a similar issue of other assessees, then the department will not file appeal till the final outcome is got from the court. So till that time they will not file appeal, they will keep it pending. They will give the they will give an undertaking. They will make an application to the appellate authorities, that is High Court or Supreme Court, stating that this is pending. before so and so High Court, the issue is pending. So we will file appeal depending on the outcome of the appeal, case. That is, if the case is in favor of the assessee, that is you, the department cannot go on appeal. If it is against you, then they can file appeal without it getting time barred. So this is very welcome move, and it will reduce the litigation to a great extent. Now the trust, they have been a source of litigation, the taxation of trusts, because trusts are required to follow a lot of rules and regulations and procedures to get the exemption. So I tell many people who come to me for starting schools and colleges, better you pay tax and have peace of mind instead of going for exemption. And now my school of thought has become correct. It is proved beyond point, because the trusts and societies under section 1023C, they were called as institutions, and trusts and societies were called as trusts. So all these several restrictions have been put, and they cannot go beyond certain. If any violation is there, they'll be taxed heavily at 30%, and they could also lose their recognition. So you have to be very careful in opting for the trust route and opting for exemption under trust. And they have to maintain books of account, mandatory. Getting audit, earlier getting audit was mandatory, now maintenance of books also is mandatory. If they don't do, a lot of penalties are there. If they make mistake once, then they will have 100% penalty. If they repeat the mistake, they'll have 200% penalty. So all these things are there. So trust, we have a lengthy discussion is there, which will not be permitted in this limited time frame of 1 hour. So this is in brief I have given. You please take this PPT from Prakash sir and go through it in detail. And you also go beyond this, read the memorandum of finance bill, and then you get some insight into the subject, and you will be able to at least have some mastery over some of the proposals that are being proposed through Finance Bill 2022. Thank you very much for your
Yeah.
kind and patient hearing. And over to you, Prakash.
Okay. Thank you, Bhananarayan Garu, because you have given, this is a technical subject. I wanted our students to expose into that sections and then updates on the taxation. It's all because they are at the entry level, and then whoever is interested in that, they can take a specialization to practice it on income tax also. I request all the participants, the students, please unmute the mics, all of you. All of you, please unmute the mics and please give him a big hand. All of you. Thanks, Chapandi. Okay, sir, thank you.
Thank you so much.
And
Thank you, sir.
enlightened us updates, sir. Okay, thank you, Bhananarayan.
Thank you so much.
Thank you.
Thank you,
Thank
Professor.
you.
Thank you, Bhan.
Thank you once again,
Bye,
DB Prakash
Yes,
and,
yes.
and all the participants.
We will have a next session also on a special topic. Okay, sir, as per you. Thank you.
Thank you, Prakash.
Good.
Garu. Thank you, Bhan,
Good.
sir. Thank you, all
Thank you.
students.
Thank you, Satish Garu,
Thank you,
having
sir. Thank you.
okay attended. Thank you. Thanks a lot. Good day. Thanks, and